Hi, and welcome to this chapter, Candlesticks. Candlesticks, or Japanese candlesticks, are an ancient Japanese invention, as the name suggests. It is a very handy tool for charting price. The candlesticks carry a wealth of information which can be used to analyze price action and give indicative tips on what the market wants to do next. It is important to note that the market is heavily influenced by mass psychology, the opinions of others. Below is an image of what candlesticks look like and the basics. As you can see, we have a bullish and a bearish candlestick. We have a high, a low, an open and a close on both bearish and bullish candlesticks. We have a wick to both sides, and we have a body in the middle. The body is the gap between the open and the close. So how do we actually use a bullish and a bearish candlestick? Or what is the structure of a bullish and bearish candlestick? A bullish candlestick will have an open, it will go low, then go high, and then come down a little bit to the close. When the close is higher than the open, it is a bullish candlestick. A bearish candlestick works as follows. At open, it goes up a little bit, then it comes down, and then it comes up a tiny bit. As long as the close is below the open, it is called a bearish candlestick. Candlestick patterns. Candlesticks in pairs or one or more can tell us about what price is probably going to do next. However, it is important to note that these patterns serve to do two essential things: to define or to confirm areas of support and resistance. So the location where you find these candlestick patterns is critical in giving the trader accurate information. We do not worry about these patterns when they form in the middle of thin air. We are only concerned when they are confirmed or defined by support and resistance. Also, it's good to note that common sense is needed when we're actually practicing or using candlesticks. Sometimes you don't have the name of the pattern formed, but by following common sense, you can determine what a candlestick pattern is depicting. Remember, every closed candlestick is a final tug of war game between the bulls and the bears. Just as we have a bull market and a bear market, we also have a bull and a bear fight between every single candle that forms on these charts. So if it's a 1 hour candle, and that means the bulls and the bears will be fighting. If it's a 4 hour candle, the bulls and the bears will be fighting. If it's a daily, the bulls and the bears are fighting. Every single time frame, the bulls and the bears are fighting. But let's say now one wins this battle between each other, and we actually have to use that to our advantage. So when the bulls win, we need to know when they've won. It's not like a scorecard that tells you. The candlestick is a scorecard that tells you. So how do we do this? First of all, we get the first type of candlestick pattern, which is called the engulfing patterns. Then we get bullish and bearish engulfing. So it's engulfing is when one candle eats the other, but then it's bullish or bearish engulfing. So a bullish engulfing is when the bulls eat the bears. It's essentially like what you used to call at school Pac-Man. When a Pac-Man used to go around on that screen and used to eat all the rest of his opponents. It's the same story happening here. The bulls have literally engulfed the bears. The bulls have eaten the bears, so the bulls have won that match. But how do we use this on a chart? We got to use it in a defined area of support and resistance. So we found our support, and then we found our bullish engulfing pattern. That bullish engulfing pattern is eating 1, 2, 3, 4, 5, 6, 7 candles of bears. So when the bullish engulfing pattern can devour more bear actual candles, that's a good sign of strength. Now let's move on to where we can find our bearish engulfing patterns. The bearish engulfing pattern is exactly the same as a bullish engulfing pattern, but just the opposite. So when the bears eat the bulls, we now know that Pac-Man with the bears has won this game against the Pac-Man with the bulls. How do we find a bearish engulfing pattern? At an area of resistance. Where resistance has been confirmed, we can then find a bearish engulfing pattern, and this bearish engulfing pattern will then send us off on a trade, hopefully for the sell. Let's remember, we sell on a bearish engulfing pattern and we buy on a bullish engulfing pattern. On to the next candlestick structure, which is what we call stars. First of all, we have an evening star. Now, an evening star, just as the sun goes up, the sun also has to come down. Now, evening, the sun goes down. What does that mean? That is a bearish confirmation of a bearish trend that's about to start. Ideally, we have the evening star consists of 3 candles or more. As you can see, this is a textbook example where we have 3 candles perfectly into the shape of a U. An evening star can consist of more than just 3 candles. It can consist of 3 to 5, even maybe sometimes 6 candles. As long as the shape of the U is there, it is an evening star. Must remember, guys, in trading, there is no such thing as a textbook example. You hardly ever see something like this as a textbook example. This is very uncommon. It's normally very undefined, and you got to identify the shape of the structure of the evening star, not the actual textbook example. Okay. So where do we find evening stars? At a point of resistance. In terms of an evening star, it will be the shape of a U, and then obviously we can look to sell. Now, as I mentioned, we get an evening star, then we get the opposite, which is a morning star. Now, as a morning star suggests, this is the sun rising. It's indicative of an uptrend about to start. So, how do we use a morning star? It is when a downtrend has been occurring, that the downtrend falls into an area of support, and then we have a morning star formation. A morning star just looks like a normal erect U, and then like I said, the structure has to look like a U. It can consist of 3 to 6 candles. A morning star can be anything from 3 to 6 candles. Like I said, this is just a textbook example. Over here, there's also very much a textbook example, but you just define what the U structure looks like, and you'll be a lot safer. Okay. Then we get what we call hammers. Hammers and inverted hammers. Let's move on to that. A hammer actually looks like a hammer. So when you pick up a hammer in real life, you pick it up by its handle. The handle is defined by what we call the shadow or the wick. Okay. The body is very small. It looks like the top of a head of a hammer, which it does, and has very little body. The open and the close are usually quite close to each other, but the wick is majority 75% of the actual candle. So that suggests to us that price came down, and then buyers pushed it back up. So there's a lot of pressure. Okay. So when the candlesticks give us your structure like this, as in terms of a hammer, regardless of the color. Okay. So it can be red or green, but it's the structure of the hammer. So if you get a hammer forming, as you can see here, like this means that it wasn't a downtrend, price went down, but then buyers pushed it up. It can end green or red, it still doesn't matter. It's the structure of the candle that matters with the hammer. As I said, the color doesn't matter, whereas a bullish engulf and a bearish engulf, morning star and evening star, all those colors matter. Whereas the hammer, it's more important about the actual structure of the candle. Okay. So how do we use to actually find a hammer in a trend? We'll have a downtrend. Okay. Then a hammer will push down. Well, the price will be bearish, push down, and then bulls will push price back up. As you can see, that long candle there, that is a hammer. That too is a hammer there. Okay, but now this is at a defined area of support. When this defined area of support is confirmed, we rather look for the hammer, bullish engulf, morning star, and then we can obviously take the trade. As you can see here, this is a bit of a morning star and a bullish engulf over here, but the hammer was our first actual signal telling us that this trade wants to take place and turn and go back to the upside. So that's the hammer. Now we get the inverse of a hammer, which is called the inverted hammer. So it can either be called a shooting star, because as a star shoots across the sky, it leaves an end trail. So does a hammer. We just like to prefer to call it an inverted hammer instead of a shooting star. Just imagine a hammer upside down. It is very, very easy. Now, as the same with the previous one was a hammer, this is the inverted hammer. It does not matter about the actual color. It is the structure of the hammer that is important. Okay, we need to remember that. The structure of the inverted hammer that is important, not the color. It can be green or red, as long as the structure of the hammer is telling us they want to go down. Okay, must remember what happened here. We had an open, a high, and then a close. Who won this game, this match? Even though the Bulls won this match, it's like Barcelona were winning 4-0, but Real Madrid came back to lose 4-3. They still lost the match, but they were the stronger team in the last, say, 20 minutes or 30 minutes of the game. Okay, same for this here. And the game ended close. The pressure was on Barcelona though. So we got to look for the structure, not the actual color. Right. That's what the story tells us about this here. So if you find an inverted hammer at a support of at a resistance level, as that there, you see, regardless of the color, it's a green color, we can look to sell. Now, it must be a resistance area for an inverted hammer, or what we call a supply area as well. Okay, must remember a supply area is just a resistance area, and a demand area is just the area of support. It's the same thing. It's just different names for basically the same thing. One's more of like a economic terminology, and the other one's more of like an actual technical analysis tool. So, but it does exactly the same thing. Alright. What you got to remember, guys, is that there's a lot of candlesticks. There's about 1,000 different candlesticks. But the thing is, if you are trading in terms of just looking for candlesticks, you will go crazy. Okay? If you're looking at the candlesticks all the time, you will be trading candles and not actually trading the chart. Even though the candles make up the chart, it doesn't form up the complete structure of the chart. Okay? You have to find areas what are called support, resistance, supply, demand, divergences. All that has to be taken into account. But obviously we'll get further into that into the course a little bit later. We get what we call dojis. Guys, a doji is actually, it's basically an indecision candle. Okay? A doji it's very much what we call, like these candles over here, it looks like spinning tops. They're not really doing anything. They're indecisive. Nor the Bulls nor the Bears won that match. Okay, so we're not really interested in those candles. So we don't actually show you them here. We just tell you what they are, but we're not going to show you exactly what they do. That's not important. Then you also get what are called tweezer tops. Tweezer tops is basically like two hammers next to each other, or two inverted hammers next to each other. So don't be too worried about what the actual tweezer bottoms, tweezer tops are. They look like hammers. It looks like two hammers next to each other. Okay. So we also get a Maribosa candle. A Maribosa candle is when a candle basically is nice and bullish or nice and bearish. So it'll have no wicks. You can see like this bullish candle here. It has no actual wicks to the upside or the downside. It's there a little bit, but it's not actually that's a bullish Maribosa. It nearly closed at the high, so it means it's got a lot of power. So when you see candles like that, that's normally what we call a breakout candle. That often has a breakout and closes quite solid. That tells us something. It means that the bull's in control there. That's essentially like a soccer match ending 5-0. Okay. Let me try to find another Maribosa here. This over here, you can call that a Maribosa. That's also basically a Maribosa. You can see it. It's just the wick is small. It doesn't have a long wick. The wicks, if the wicks are long, we know that something's about to happen. Okay. So guys, with that, you can move on to the next chapter, which is candlestick retracement. In that chapter, we show you more a precise entry game, where you get what we call an immediate entry and a retracement entry. For majority of beginner traders, they take the immediate entry, but for a more of a professional trader, we wait for what we call a retracement entry. So with that, please move on to the next chapter and study these candles very, very well, guys. Please, this is probably, as I said, the 6th most important chapter on this course. So please finish that and study it well. Thanks, guys.